You've probably heard the term EBITDA, but might not know exactly what it means. What is it? What is it used for? And how do you calculate it? You'll be able to answer these questions by the end of this video. Let's take a look at what is EBITDA. Six. What is EBITDA? EBITDA stands for earnings before interest, taxes, depreciation, and amortization. EBITDA measures a company's overall financial performance. It is often used as an alternative to other metrics, including earnings, revenue, and income. Before we dive into what EBITDA signifies and how the numbers are employed, we will take a look at the key terms in the name: interest, taxes, depreciation, and amortization. Interest include business expenses caused by interest rates, including interest on loans by banks or third-party lenders. Taxes comprise any federal income taxes and state or local taxes imposed in the region by the government and regulatory authorities. Depreciation, an expense that indicates the reduction in the value of fixed company assets. It is a non-cash expense that signifies asset value reduction. Amortization, another non-cash expense that involves the cost of intangible assets. It can be defined as a process that gradually writes off the initial cost of an asset. EBITDA focuses on the financial outcome of operating decisions by eliminating the impact of non-operating management decisions such as tax rates, interest expenses, and significant intangible assets. Consequently, the measure gives a figure that clearly reflects the operating profitability of a business that can be compared with other companies by owners, investors, and stakeholders. It is for this reason that EBITDA is often preferred over other metrics when deciding which business is more attractive. EBITDA may be calculated for an accounting period of a company. LTM, last 12-month EBITDA, is a valuation metric representing all earnings before adjustments associated with interest, tax, depreciation, and amortization in the past 12 months. LTM EBITDA also goes by the name of TTM, trailing 12 months EBITDA. 5. EBITDA in business valuations. EBIT is one of the many EBITDA variations. The main difference between EBIT and EBITDA is the number of steps taken to reach a relevant and meaningful value that helps owners and stakeholders make decisions based on the company's financial health. EBIT, or earnings before interest and tax, represents the value of earnings without the effect of tax rates and interest. EBITDA takes it a step further by removing and identifying depreciation and amortization expenses as well. Both EBIT and EBITDA come in handy to understand the bigger picture of a company's value by breaking down different expenses and their impact on the business's worth. In addition to EBIT, there are several other variations of EBITDA, including EBIT, earnings before interest after tax, EBITDA, earnings before interest, depreciation and amortization, EBITDA, earnings before interest, tax, depreciation, amortization and restructuring rent costs, EBITDAC, earnings before interest, taxes, depreciation, amortization and coronavirus, and more. All values help build a picture of the company's value. Potential buyers and investors generally employ EBITDA and its variations to compare the valuation of different companies. On the other hand, business owners can benefit from EBITDA by using it to enhance their exit strategy and take numerous business decisions, particularly operating decisions. EBITDA is also compared with seller's discretionary earnings, SDE, that is used to determine the historical cash flow of the business. Think of it as a recasting process that starts with net profit. The owner's salary and non-cash profits are then added to the net profit. SDE is similar to EBITDA. The main difference that settles the EBITDA versus SDE debate relates to the size of the business. EBITDA is generally employed for larger corporations and organizations, whereas SDE is more suitable for smaller companies. 4. EBITDA calculation. How to calculate EBITDA. Accurate EBITDA calculation is a key part of the overall company valuation. Accountants employ two formulas to calculate the EBITDA value. EBITDA equals net profit plus interest plus taxes plus depreciation plus amortization. EBITDA equals operating income plus depreciation plus amortization. The information required for EBITDA calculation should be included in the company's income statement. Here, it is important to reiterate the importance of accurate results, as inaccuracy can result in over or under evaluation of the business and company's profitability. Therefore, it is advisable to invest in a reliable accounting system or consider working with experienced and trusted accountants when keeping your financials up to date to ensure accurate EBITDA analysis. 3. Why is it important to calculate EBITDA? Understanding EBITDA calculation and evaluation is important for business owners for two main reasons. For one, EBITDA provides a clear idea of the company's value. Secondly, it demonstrates the company's worth to potential buyers and investors, painting a picture regarding growth opportunities for the company. It analyzes and compares profitability among companies and industries, as it eliminates the impacts of financing, government, and other accounting decisions to provide a raw indication of earnings. Therefore, it is readily used by owners, buyers, private equity investors, and analysts worldwide. It is an important standout formula that provides an overview of the business value, assisting companies and individuals in making important business decisions. It can also be used as an alternative for cash flow. Moreover, the EBITDA multiple can provide an estimated valuation range for the company. 2. What can you do to increase company EBITDA? Company owners strive to present EBITDA and other statistics dating at least 3 to 5 years back when presenting their company's financials for the purpose of exiting the business. This amount of data shows how the company has grown over time, telling purchasers that the potential for continuing growth is good. Higher EBITDA indicated better company performance. Therefore, business owners can take measures to improve the company's EBITDA to make the company more attractive to potential buyers and investors. It can be achieved by recasting company financials. Recasting EBITDA value. Recasting can be described as the process of amending or re-releasing earnings statements with specific intent. Here, the financial experts will go through company financials to reinsert any one-off expenses or earnings. The re-examination of the financials with the required adjustments will lead to a clearer and more promising picture of the business for potential buyers. However, keep in mind that recasting is not the same as hindering the numbers to manipulate the buyers. It is not an opportunity to hide facts, as any discrepancies will be uncovered during the due diligence process. Several aspects of previously published statements can be recasted to enhance the EBITDA of a company to present a more accurate and relevant picture of its value. Here are some of the aspects you may want to recast. Expenses or revenue from non-essential assets. Buyers may not recognize expenses or revenue associated with unnecessary assets. For example, imagine that you rent a property in the country for a corporate retreat every year. A potential buyer may not recognize this cost. One-time fees. Buyers are more interested in learning about the ongoing costs they will incur once they take over. Therefore, if you spent money on a one-time marketing campaign or litigation, these costs do not represent the ongoing costs that the buyer would have to take on. 1. Benefits and drawbacks of EBITDA in business valuations. Benefits of EBITDA. It's commonly used, as mentioned earlier. EBITDA is very commonly employed by many groups, notably buyers and investors. So it is a language that they are very familiar with, meaning they can use it effectively to compare business valuations. It eliminates unhelpful variables by removing elements like interest rates, tax rates, depreciation, and amortization that are unique from business to business. This provides a strict illustration of a company's operating performance. It's easy to calculate. All formulas associated with EBITDA are straightforward to determine as long as your financials are accurate. This also makes it easy to understand on all sides of any negotiations. It's reliable, as it enables investors to fully focus on a company's baseline profitability. EBITDA is considered a more reliable indicator of its financial soundness. This way, you have a clearer idea what values can be eliminated from the equation, ensuring nothing causes problems at the due diligence stage, which could result in a breakdown of trust and a loss of time and money. Do share with us in the comments what is your company's calculated EBITDA. Thanks for watching.